Hey there, guys and girls, and welcome to another episode of The Finnovator with me, Stuart Bell, business coach and founder of Adaria Coaching Consulting. Today's podcast or masterclass is one that has actually been sat in the pipeline for quite some time now. We kind of overlooked it for some strange reason. Maybe it was because I think it was recorded back in the murky days between COVID, but I really wanted to, having discovered it, get it out there because it's a real cracker. In this episode of The Finnovator, I sat down with Chris Hestelow and Julian Morrison of Allan. We spent some time diving into one of my favorite topics, which is all of these things about behavioural economics and ultimately, this science behind making great decisions. And what I love most about this is not the fact that, you're talking to two people who really know their topic, but also got an opportunity to sit down with Jules in a professional capacity, because he and I go way back, having shared a house way back in Sheffield in the 90s when we went to university together. And as I often tell people, Jules is without doubt one of the smartest people I know. A person who does arbitrage in his spare time as a kind of hobby on the side. But anyway, that's enough from me. I hope you enjoy this one. I know I did. And so I'll leave it to Jules and Chris as we dive into the science of making great decisions. Today's session, today's masterclass, today's chat with Julian and Chris came about because, firstly, I think, it's been such an intense year. It's been a year when there's been so much going on, so much thrown at us. And sometimes I think when you've got that situation, what we really need is kind of something to completely change direction, think about things differently. And when if you're talking about thinking about things differently or doing things differently, when you're talking to someone from Allan, that's essentially what the proposition is. And, I thought about, let's do something on behavioral economics or behavioral finance or however you want to call it. Jules and Chris were two of the first names that came to mind. To give you a bit of a background, I've known Jules for many, many years, head of research and relationships. And he'll hate me for saying this, but, I'm saying we've known each other for 25 years plus. He is without doubt one of the smartest people, I know. And just sitting down and talk to him about this kind of stuff, yeah, it's just an amazing experience. I don't know many people who do arbitrage as a hobby, let alone describe the CFA or the Chartered Financial Analyst course as a little bit tricky. Chris is the relationship manager at Allan, and he and I got chatting as well, and he has actually got a wealth of knowledge about this too, but he's going to come at it from a slightly different angle as well. Chris and Jules, are you there, guys?
Yep.
Hi, Stu.
Beautiful. How are you going?
Hi there, Stu. How are you?
I'm very well, thanks. Let's get your videos on. There we go. Love it. How are we both?
Not too bad. Not too bad at all.
Very good, thanks.
Same question, you guys. Where are you right now?
Well, I'm in the office. I thought that's the best way to stop all of those horrible things that can go wrong, whether it's internet or the dog running in at the wrong time or the neighbors doing some pressure washing right as you start an important call. So I decided just to come into the office today.
You can avoid. Remember that guy who was doing a live feed on CNN and his nanny and the little kid ran in on the background? Do you remember that one?
Yeah. That's awesome.
I think if it did it now, people would be like, yep, so what? That's happening to everyone, right? Jules, how about...
I'm operating from home, as you can probably tell from the background.
Yeah, what's going on in the background? Are you having home renovations?
No, I'm just seeking a bit more risk in case those things do go wrong. We'll see how that goes.
Hey, should we dive into it? Because this is I think it's a fascinating topic. First off the bat, for people who don't know you personally or don't know enough about Allan to understand sort of, why being different and this kind of topic area is a real area of strength, can you give us like the 2-minute background to yourselves and to Allan?
Sure. Maybe I'll jump in.
Yeah, sure.
For myself, my own sins, and by the way, Stu, thanks very much for the kind introduction. It was far too kind. Maybe I wouldn't go so far as saying dressing mutton up as lamb, but I think what I could say is that I do have a fair bit of experience in financial markets and observing those. I started my career late in the stages of the tech boom of 99 and then joined a big investment bank almost right on the peak. So I started with a bit of a 3-year downturn, which was a good learning experience, and then sort of study of Benjamin Graham and various other renowned people within behavioral finance, Daniel Kahneman. But I think the main thing is in practice and interest in that and applying that, and that's probably the most important thing. And I think that's what's so interesting about this and why I think it's great that you make this such an interactive session, because it's something that everyone has experience in, without a doubt. It's almost by definition, and and everyone's got something unique to contribute on it, an experience. So, looking forward to it. And in terms of Allan Gray, it's a very long-standing group, going back around 45 years overseas and about 15 years in Australia, contrarian long-term investors. And so at the heart of Allan Gray's investment approach, our sister companies called Orbis as well, which is the global side, but the investment approach is focused around human behavior and mistakes that people make, and trying not to make those and trying to capitalize on those yourself. So that's sort of where we come at it from an investment perspective. Yeah. Maybe over to Chris. Do you want to give a bit of background?
Yeah. So, I studied economics and finance at university, and I've always been interested in it. But one thing that they do in economics is they teach you, you need to try and simplify a very complex world. And so what they do is they make some assumptions, things like, all else being equal. And one of the big assumptions they make is that people are rational, self-interested. They have consistent preferences. They apply them consistently over time. And that's just not the way that things are. So, economics is hugely useful, but I think when it's paired with an understanding of, the mistakes that people make and the mistakes that people consistently make, that can help you make better decisions, both in kind of your personal life and also in the markets as well. So, since especially joining Allan Gray, I've been looking further and further into this and just find it hugely interesting.
Yeah, me too. I think a lot of people got into this. Well, you obviously got into uni, but it's books like Freakonomics and Tipping Point and, Outliers, that kind of thing where you analyze what really happens. I also come from an Irish family, so anybody who's familiar with Murphy's Law, some would argue that Murphy was probably the first behavioural economics. Said, yes, that will go wrong, could go wrong, will go wrong. But, let's dive into this, because, what I'm interested to know is why this is such a focus of Allan Gray. Like, how is this focus on decision making and almost challenging not just your own decision making, but other people's? Why has that become such a feature of the proposition? And as a result, something that you guys know a lot about.
Yeah.
Chris, do you want to start on that?
Yeah, sure. So if markets were perfectly rational and if people were perfectly rational, there wouldn't be much of a chance to outperform the market. One thing they teach you in economics is the efficient market hypothesis. And there's different forms of that and it's debated, but if it holds true, basically all available information is perfectly impounded into prices almost immediately. And if there's any deviation from what something's worth, from what it's trading at, that should immediately be arbitraged away. And if that was the case, you couldn't really make excess returns as an active manager. But we don't think that's the case, at least over the short term. We think markets are rational in the long term. But if you look at anything like the tech boom or the global financial crisis, or just how much, stock prices can swing day to day or intraday, it's quite clear that they're not perfectly rational. And over the short term, they're driven by all of those human emotions and biases, that we are affected by in our personal lives. And two of the big things that happen is people seem to be overconfident on the upside and they impound what's happened recently, and think that's going to continue forwards. And they also can be overly pessimistic when there's bad news or a company isn't doing well. And, those emotions come into play. It's been losing them money. They just get rid of it. And so from an investment perspective, we think the best chance for us to make an outsized return is when people are making those emotional mistakes. And that gives you the chance to buy something cheaper than it's really worth. So the companies that we spend a lot of time focusing on and analyzing are those companies that are very out of favor with the market, that are very uncomfortable to hold, and people just often just want to get rid of it, solve the problem, sell that share because it's uncomfortable. And we think that's the best opportunity for us to buy something cheaper than it's really worth.
It's interesting you raise that. I had a friend of mine who, we were chatting, it was about a year and a half ago. We're at his birthday and we're talking about Bitcoin. And this is the time that Bitcoin had gone and it come down again. And, he ended up making a bet that within a year it would be up around 50,000. And unfortunately, as a result, he lost the bet. He couldn't cut his hair for 6 months. Anyway, it was terrible. But that's an interesting thing. You've got somebody who's obviously invested so much in something, and the contrarian view at that time was Bitcoin's got no intrinsic value.
Mm.
People who think it's going to replace the global currency don't fundamentally understand there's a ceiling on the amount of Bitcoins. And so that's an interesting one, because he was a contrarian view, but it was still the wrong view, right? How do you be contrarian but not allow contrarian to be the mistake itself?
Yeah.
I think, it's very important, whatever approach you take to investing, to have humility, and avoid falling into the trap of overconfidence. And that's one of the key behavioral biases, is overconfidence in whatever it is. You form your view, and then you're wedded to it. You find things that confirm it rather than refute it. Yeah. And you fall into that trap. I mean, so the starting point is to say, okay, in the scheme of investing, to say, I will get some stuff wrong. Some of the stuff I own, if I'm aiming to outperform by holding lots of things, some of those things will underperform, and that's bound to happen, right? So it's to accept that in the first place. If I own an index fund, almost by definition, probably 50% of my capital will outperform the market, and 50% will underperform, give or take. So if I can push that percentage up to 60, 65, maybe 70 at the outside, that's enough to put you right at the top of the performance tables over the long term, if you do that over the long term. So that's the first thing, to be accepting of, there's a range of outcomes, and some of the time you're going to fall in that 40% or 30% or whatever it is. Okay. I mean, I can give you an example. I mean, there's a whole litany of examples, but one of my own from the past was in that period of the tech boom and bust in the year 2000. At the depths of that, 2002, I personally bought into Marconi, which was a long-standing production sort of manufacturing company that went into telecoms in a big way, overspent and destroyed itself, or the management did. And the share price plummeted almost, 90% or so or more. Jeez. And I and a colleague put our money together. We were just formative stages of our careers. We put our money together to buy shares. So even then we were sort of taking a contrarian approach. We said it's cheap, and we went to zero. We sold just before it went to zero and had enough to buy a couple of beers. And so actually the bonds did very well because it restructured, and the bond owners did pretty well. The lesson to be learned from that was you have to have a solid basis for investing. So first of all, behavioural and contrarian investing is fishing in that pool, being willing to fish in that pool. And there's a very strong reason for that, and we can get onto that. But once you are fishing in that pool, or whatever pool you are fishing in, you have to have a solid basis for your decision. And in this case, it's think like a business owner. If you were buying another consulting business, or someone was buying yours and you had to work out the valuation, or if an advice business was being valued, there'd be thorough due diligence. There'd be a long negotiation, very pointed discussion. The buyer wants to pay a low price, the seller wants to pay high, and understanding that and what drives the value. And it should be no different in listed securities, but it is. People tend to see the share price moves around and say, I think it's moving upwards. I think this thing looks good, so I'll buy it, rather than, and it's surface level. So I think that's the key thing. It's have a fundamental independent view, but being willing to fish in that pool. Just to make a key point there, it's about competition. So contrarian investing and leaning against behavioral consensus is about not facing lots of competition. So sentiment is positive, competition is higher. You're queuing up to buy something, you'll buy a higher price. So go where that's not.
Tim Ferriss, he talks about a Harvard lecture he used to give, where he would sit in front of like 60 of Harvard's brightest people, and he set them a challenge. He said, all you need to do is reach out to 3 famous people and get 3 responses. And if you do, I'll pay for a ticket around the world. And out of all of those people, in the first class he did, none of them went for it. And it's interesting, none of them went for it because they initially went, that's too much competition. Yeah? And actually he tells a story about the next time around, he told people about what happened, and still only 2 people went for it. So it's interesting to the point, which is sometimes people, not only is there a lot, sometimes it's hard, I think the point he made is sometimes it's easier to achieve amazing things because there's so little competition to actually get there.
Yeah, I think that's right. Sometimes you hear about scholarships that just didn't have an applicant. These obscure scholarships that maybe a family has created for university and no one applied, or sometimes one person applied and they just got it by default. So that certainly can happen.
It's like, for example, I speak to people about getting published in the media, and they're going, it's actually remarkably easy to get an article out. published. Most people don't even ask. So I guess if there's one thing we take from that, head towards, what seems like it would be hard, because often they're easier than you realize, right?
And examples in real life. I mean, I remember at school doing my A-levels or equivalent to HSC, I got into the athletics team to run the 400 meters. I was an okay sprinter, but I wasn't the best in the 1 and the 2. So I didn't get in there, but no one wanted to do the 4 because it was hideous. It's not 800 and it's not 200. It's, so the lack of competition was the aid there.
Yeah. I think I had the same experience being a shot putter, but anyway. We're going to dive into 4 specific areas that I'd love to sort of pull apart with you guys, which are, firstly, thinking systems. There's a lot of research been done, particularly in the last 30 years, around the way that humans think. So I'm unpacking some of that. I also would love to talk to you guys about, there's so much information around. You were making the point, Chris, about efficient market theory. If you would think that in a market where information is constantly updated on an hourly basis and there's so much available that we'd be making smarter decisions, but that's often not the case. I want to talk about how, you manage an increasingly high body of information and the common issues. I'd love to talk about biases, which anybody who's done their ethics will know this is probably as a big topic. And finally, I want to talk about the decision-making piece. But before we jump in, I'd love to know your take on why you think having a handle on some of these concepts or understanding can be useful for advisors themselves, and equally, how you think it can be important. Elizabeth, how you think it's important when you're working with clients who, maybe have the biases, they're taking a lot of information and they have decisions to make.
Yeah. So I think it's why these things are so important is that, I think it's usually attributed to Mark Twain, but there's a quote that says, it's not the things that you don't know that really get you into trouble. And I'm kind of awkwardly paraphrasing, but it's the things that you know for sure that just ain't so, it's the things that you can be very sure about. And a lot of our biases lead us to be very sure about things and definite about things, when it's just not the case, and that can really get you into trouble. So I think that's partly why it's critical to understand these things, both for advisors and for the clients.
I totally agree. And often it's by, I'm a great believer in, even if you think you know the answer, ask 2 more questions. Because there's the ability to miss out, assumption makes an ass out of you. And it's totally true. If you have the option of getting more information, why wouldn't you? Let's dive in, but should we do we were talking about doing a bit of a test.
Yep. Yeah, that's probably a good lead in.
It is a good lead in.
So maybe I'll do the test and then Jules can explain what's happening.
Okay. So the background to this, guys, is we thought we would like to do a couple of live examples of, bias or decision making that is based on certain thinking, and explain why potentially people get challenged by it and a whole bunch of other stuff. So this is interactive. So take a moment, listen to the question. I want to know your answer in the chat box, and then we'll talk through what it's demonstrating. Sound good? And I got your message, Elizabeth. We'll dive into that. So if you're ready, Chris, fire away.
Sure. So there's many different questions you can ask. And if people want more of these to use with their clients, just reach out. But, one example is a bat and a ball cost $1.10 in total. The bat costs $1 more than the ball. How much does the ball cost?
So bat costs $1 more.
Yep.
How much does the ball cost? Okay. Let's have your...
And they cost $1.10 in total, Stu.
Yeah, we should say that. Total, $1.10. Beautiful. So, okay. Over to you guys. A bat and a ball costs $1.10. I think I got this wrong, actually, when you did this to me. The bat costs $1 more. How much does the ball cost? Kim knows the answer, so she's not going to spoil it. Tom said ball is 5 cents. Hang on there. Let's give everybody else's answers. Tom, first cab off the rank. Mate, you had your coffee, obviously. Maybe not. Maybe you don't drink coffee. Let's hear the rest of your answers. Olivia, I'd love to know what you... Angela. Brad. Elizabeth. Jen. Tom's already answered. Let's keep it coming, guys. Bat and the ball. Where could you buy a bat and a ball for $1.10? Man, that would be... You can tell this question was sort of written back in the 80s or maybe even the 50s. Elizabeth says 10 cents. Angela's bias has kicked in. She thinks there's a trick at play there. That'd be an interesting bias to talk about. 5 cents is Olivia. Okay, I'm going to give you five more seconds. 5, 4, 3, 2, 1. Margaret says it's free. It is if you're famous. Okay, what's the answer?
Yeah, so it is, the ball does cost 5 cents.
Beautiful. Okay. So tell us what that's actually testing. What's the point of asking that question? What's the bias or the thinking system that potentially leads us down the wrong path? Jules?
Jules, you want to grab that?
Yeah, so this was a guy called Shane Frederick came up with this test called the cognitive reflection test. Some of you may see it before. It's been around quite a while, and it's quite useful. It's quite amusing in a way, but it's quite useful as well. So, and it's around the fact that your brain operates in two ways. One is to make quick and dirty decisions in the sense of shortcut conclusions and going approximately it's this. This looks like this to me, based on familiarity. And the other way is slow and logical and calculating things like if you're doing a long division sum, which is onerous and painful. And this test is intentionally to try to tempt you to use the first thing, to rush it and to do the shortcut. So your brain says $1.10 in total. One of these things costs $1, therefore the other must cost 10 cents. Yeah. But together they cost 110, so that would be 120, so it can't be. So the logical answer is 105 and 5, as Tom said and as Olivia said. But many people will go for there's two more questions to this. For those who haven't seen it, we can send it around afterwards. Yep. With two other questions. It may be useful with clients because it illustrates these behavioral errors. Shane Frederick tested it on 3,500 people in his initial test. 17% got all of them right. And 33% got none of them right. And then sort of in between. And we've tested it on financial advice PD days and things like that, and we get similar type of stats on the results. But it's interesting, it's that shortcut decision making that it's trying to illustrate.
So that's, there's a book around this, I think, Thinking Fast and Slow by, I'm not sure who the names are in there, but the main thing I took from that is feel free to make a gut decision, and it works for everything. Make a gut call, then go back and use the data to find out whether it's right. And then if it's right, go with your gut. But yeah, that was useful. Have you got any others, or was that the main one we wanted to cover?
We could do another one if you think they'd find it interesting.
Yeah, do you want to do another one? Yeah, let's do another one.
Okay, all right. In a lake, there is a patch of lily pads. Every day, the patch doubles in size. If it takes 48 days for the patch to cover the entire lake, how long will it take to cover half the lake?
Okay. So there's a lake and lily pads. The lily pads double the coverage of the lake every day. If in 48 days, the lily pads will cover the lake, how many days until they're half covered? Okay, over to you guys. Let's go 20 seconds on this one. Depends how quickly you, I don't know, do you kill off lily pads? You don't, do you? No, you don't do that. Another week. How are we going there? Lake and lily pads, the lily pad cover doubles every day. 48 days it'll be covered. How long until it's half covered? Tom says 30 days. Brad, give us your answer, man. Martin, Margaret, love to hear from you. Tom says 30. How are we going? 10.
See, at this stage, everyone's scared after the first one.
8. 7. I got this wrong too. I got this badly wrong. So I had to think very deeply about it. 5. Good quick guess. 4. 47 says Martin. 3, 2, 1. What's the answer, guys?
Yeah, so the answer is 47 days.
Yeah, 47 days.
At 47 days, half the lake is covered, and a doubling of that amount of lily pads completes the entire lake.
So what's going on here?
Yeah, that's just the same thing, We're just using that fast decision-making process most of the time when we see a question like this. You think, okay, it takes 48 days, and most people would give the answer of 24 days. Yeah. Because we're using that just fast decision-making center of the brain. Probably the other thing to say on that is that, it's not necessarily a bad thing, as you said, to use that fast decision center. If we used our slow decision-making process for everything every day, getting dressed in the morning, brushing our teeth, we would never get anything done. You do need that fast decision-making process, but we just need to be careful of those situations where, and there's many situations in finance and in budgeting and in those kind of financial decision-making processes where if we use those fast decision-making process, we're often falling into that trap of using a heuristic or using a bias and not necessarily making the choice that's best for ourselves.
To add to that, we can make horrendous decisions using our slow logical decision-making process. If we're driving down the road and we try and figure out everything precisely before we turn or make a decision, with the natural instinct, we're very well attuned to our sight and our sound and our depth perception, all that, to make these instinctive decisions. That's why it's there. And as Chris says, we probably wouldn't be around if we didn't have it. So it's a great thing we do have it, but it's just not well suited for complex, stressful decision making, such as financial market investment.
There's another interesting thing going on. One of my favorite quotes, Einstein, where he said, compounding is the eighth wonder of the universe. And for those of you on the program, you know we've got a model called the four futures. And one of the things it demonstrates to people that, you know, one of the most important things in advice is to make a decision what you want to aim for in terms of, you know, level of wealth, lifestyle. But the second most important thing is how soon you start. And this is one of the things that the moment you said it to me first time, I went, you know, if it's 48 days, it must naturally be 24. Because humans don't understand the power of compounding. Exponential growth is very difficult to comprehend, which is why a lot of people, for example, straight off the bat, if you start working with a planner and after 10 years working with them, you're looking at it and going, you know what? I think, I thought I'd be, you know, 30%, you know, more progressed than I am right now. You're not taking into account the fact that most of, you know, 75% of the results are going to come in the last 25% of your journey because of compounding. And I think if you're looking at for clients, it's really important. I mean, there's a really good little snippet here where you say, you know, if you had a cent and it doubled every day, day after day after day, how long would it take you to become a millionaire? And the answer is 27 days. You know, after a month, you've got $5 million in the bank. And I think when you're talking to clients about sticking with a strategy over time and, you know, watching it compound, I think this is exactly a bias that you know, really important to point out.
There's a great apocryphal tale which others may have heard of, which suggests chess originated in China, and the inventor of the chess game and the board, the king summoned, or the emperor summons him and said, "This is so great, I'll give you any reward you want. What do you want?" And he says, "All I want is 1 grain of rice on the first square on my chessboard, and then double that every single square, the whole board, which is only this big, and that can be sufficient for me." So he says, "Fine, is that all you want? Great." So the guy goes away, and then he summons his treasurer or whatever, and the treasurer just starts sweating and says, "Aha!" Because the quantity, if you double it up for those 60 or 64 squares, is unfathomable. It's just
yeah, it's incredible.
So that's the same point you make on the incredible. I think also the more tangible in the financial advice world, and I'm sure many on the line have used similar sorts of examples. The first time I saw this, where it showed, I think at age 21, you start investing and you make a certain contribution, called $1,000 a year, and you assume a certain rate of return.
Yeah.
Someone else starts investing at 31. They invest all the way from 31 to 65, and the 21-year-old stops at 31. Never invest another cent. Who has the most at 65? Now it depends on the assumed rate of return, but say it's 7%, I think, or a little bit more.
Yeah.
That first person has more at the end, even though they didn't contribute for the last 35 years because of the compounding.
It's just, yeah, I mean, that's the whole thing. If we can, as an industry, if we can find a way of getting people to start on this path sooner, what they have to do at the beginning is it's a much more gradual implementation of strategies. But traditionally, one of the problems is, you know, a lot of people rock up to an advisor when they're 55, 10 years out from time, and they've done nothing. And that's a hard conversation because there's going to be some stuff off the table straight off the bat. But, let's dive into some of the meaty stuff, shall we?
Sure.
There's a couple of questions that have popped up around decision making. I know we were going to start elsewhere, but can we talk a little bit about decision making? Like, when we think about, this field, what does it tell us about some of the flaws people have in decision making? Equally importantly, when you see flawed decision making, how you can help yourself take a step back and fix it, or alternatively, you know, help clients to fix their decision making?
Well, I think it's useful to start with the absolute basics and say, what is your brain doing in terms of its decision making? I think at the most basic level, your brain is constantly seeking out reward and trying not to experience pain or bad circumstances, things that would hurt you and cause you stress or worry or whatever else it might be, or physical pain.
Mm-hmm.
So whether it's investing or anything else. So that's the first thing. And I think a key message there is, and then your brain responds, there's a response, and that may be subliminal or unconscious. So I think awareness is key. First of all, awareness is critical, and to continually, particularly within the field of investing, but more broadly in advising clients, when they think about their lives and their experiences, it's not crazy. People say the first sign of craziness is talking to yourself, but it's not crazy to talk to yourself about these things and to say, why am I feeling this? What is this greed that I'm feeling? If I want to pursue, I don't want to be biased for Afterpay or something like that, where everyone's made money and I want to make money. So I think an awareness is a key thing. And I think the other thing, I'll just stop in a second, but the other thing I hold very close in terms of its importance is understanding the difference between outcome and expectation. And that's all important. Aside from investing, I think in terms of life, we measure our achievements compared to our expectations of what we're going to do. And the gap between those things is what dictates our emotional state. So we say, okay, I've not achieved versus my own benchmark. And then we start to compare against other people as well, which then compounds the whole thing. And so I think to detach yourself from that and to say, what is achievement? And I think importantly, achievement is very different from wealth. The two are different. Success in investing will be related to wealth, but success in life is a very different thing. And so the other thing would be when you do relate that outcome versus expectation to investing, that is one of the key drivers of share prices or bond prices or asset prices. It's people have priced in fantastic and things turn out just to be good. The share price can fall massively, even if it's good, because the expectations were higher. And if the price is dreadful and it turns out to be average, then you can do very well.
So the stock market is not about what's going on now. It's about what the market thinks is going to happen in the future, which is where you can, I guess. I want to dive into that. The pain reward thing. Is that, I know that if you look at a lot of sales theory, it's like, some of the worst kind of sales is just push the pain button. But you're saying there is the research is showing that people are more attuned to want to move away from pain than they are drawn towards reward, or is that the case?
Yeah, that's right. So the word for it is, or the phrase is loss aversion, and how it's usually described is losses loom larger than gains. I think that might have been Kahneman too. But basically the original researchers looked at, how much we suffer if we lose $100 versus, how much reward or good feeling we gain from gaining that $100. And, there's been a lot of people who think it might not be quite as large as this, but their data showed that we feel losses 2.25 times more painfully than a corresponding increase in happiness from gaining the same amount.
Wow.
Yeah.
2.25 times stronger.
Yeah. So the negative emotion of losing an absolute value is much greater than the positive emotion you gain if you were to be given that same amount.
It's worth actually just making this practice with, if we were to talk about retaining clients in a practice, let's say a client, you're having a conversation about whether they should stick around. One of the things that's really important to point out is that the thing that's going to more likely to want to get clients to stick around. Obviously, if you're having a conversation with a client, they're not happy. You need to get to the heart of it and try and fix it. But you can sit there and pitch your business and go, but if we stay together, we're going to do this differently. That's not the thing you should be talking about. The thing you should be saying is, look, we've built up all of this information. We've got this relationship. We're on the right track. If you disengage, are you going to start again from scratch? Are you going to throw the strategy out the wall? Are you going to invest $5,000 or $10,000 writing a new plan? Or do you want to see if we can stick with this for a year, fix it, and in a year time, if you're not happy, we can review it? Because that's essentially what you're asking to think about what they're going to lose, which many times when they're making a decision to disengage, I don't think clients are thinking about that as strongly as they should. Is that fair?
Yeah, I think so. Yeah. And it's probably, a little bit of that might be done for you. So there's another closely related aspect, in behavioral finance, which is called the endowment effect. And that is, as soon as we own something, we see its value as higher than it was prior to us owning it. And an interesting example of this was they did an experiment where they went to a university campus and they said to random passers-by, look, how much would you buy this mug for? Just a normal coffee mug.
Yep.
And then they switched up the experiment and gave a bunch of people a coffee mug for free as they were wandering into the university, and then had someone walk up to them and say, oh, could I buy this off you? And in that second situation, people, the average price at which they would sell the mug was more than twice the cost that someone would buy it. Which is basically to say, and I'm sure everyone has examples of this in their own personal lives, as soon as we own something, we ascribe a much greater value to it.
Yes.
That's probably why loss aversion, why it is so painful. For, advisors with clients, that can be an issue because, maybe you're talking to a client and maybe they, the way that they value the their home is so great that, they persist in staying in a 5-bedroom house even when the kids have moved out, when, their utility or their overall happiness might be much improved by downsizing and having that additional capital to use. So those kind of things could be quite useful, I think, for advisors too, recognizing what's happening when someone says, I can't sell that, even if there's maybe a better option out there.
Chris just mentioned a very important word there as well, Stu, which is utility, which when we use the phrase perfect information in economic theory as opposed to practice, perfect information means people have all the information, all the data that they could want and need about markets, prices, everything, and also about their own utility curve or what causes them so much utility or not, which means they understand how much they need of each thing to make them feel right, to make them as happy as they can be. And I think, as Chris is saying, people don't have a firm grasp on that. So I think approaching that carefully and saying, actually, because one example is trying to attain much more than you would ever need to make you happy. It's, you're on the wrong path, sort of thing. So.
It's one of the areas that this can really work is if, I've seen advisors where they bring a client on board and they do a lot of work. They don't tell the advisor, they don't involve the client and, I'll just do it for you. And they put a plan in front of them. And because the client hasn't actually been involved in the process, because they haven't had to, put some effort in, invest some time, it becomes a much less valuable thing and it's an easier decision for them to walk away. Whereas where they're actually involved and they can see the process unfold and they have input, it kind of triggers the same thing as these, Once we put all our apps in it, we put our photo on it, it becomes an extension of us. And I think if we can use that to make the plan something that they created as much as advisors, I think it becomes more valuable.
So that's just such an incredibly important thing, I think. With all of these biases and potential mistakes that people can make, investing or otherwise, I think the key thing, particularly when it comes to financial advice, though I'm not an expert nor an advisor, is at the start, and I'm sure everyone on the line engages in this, but I think it's so important to reiterate at the start to have in place what are you going to do? What is the range of outcomes? What does a terrible thing look like? What does a really good thing look like? And how are we going to behave? How are we going to deal with that and have a plan to deal with it? I'm sort of thinking probably more specifically from investing to say if we own this thing and it's gone down a lot, how will we assess whether we should sell it or add more or remain in it or what to do? And vice versa when something goes well. And that sort of comes to that Rudyard Kipling poem, If, where he says, if you can meet with trap and disaster and treat those two imposters just the same. The point is, an average outcome, purely by definition, is far, far more likely than either really good or really bad. But people, once they latch onto a decision, usually, assumption investing that something's going to be good or bad, and I'm investing based on that, not that it's going to be average. And that comes down to this outcome versus expectation thing as well. If you can invest and assume everything's going to be average and only invest when the expectations are poor, you might do well.
It's what Dalai Lama said. He said happiness is comparing yourself to those who have less. Sadness is comparing yourself to those who have more. If your expectation of something is set high and you don't hit it, then it's one of the problems with high achievers. They're very capable of getting there, but they're very rarely capable of enjoying it when they do, unless you point it out.
Yeah, I think that's right. Yeah. I mean, that's how humans think. We compare ourselves to other people. And that's why, you don't see this kind of linear increase in happiness as people get more money, often it's the billionaires are just as, terribly depressed as someone else could be. It's because whatever you have, you look to what everyone else has and what your neighbor has. And so I think the form of goals, assist, because as soon as you state what you want to achieve or what you want to get to in the future, and you might do that with a client, make it really clear what they're aiming towards, you're no longer comparing yourself to other people, but you're measuring yourself against something that you've set for yourself.
Just one other quote to throw in, I was going to say, from JP Morgan, going back over 100 years. He said, there's nothing in the world which will so violently distort a man's judgment more than the sight of his neighbor getting rich. And I think that's just a reminder of how sensitive we are to comparisons versus other people.
It's worth popping in at this point. I mean, I'm going to talk about decision blockers in a minute because Elizabeth asked that, but we're kind of talking about anchoring a bit, aren't we?
Yes. Yeah.
Like when we make comparison, often, like classic example is a client comes into your office as an advisor, and, you're talking through it and then you put the fee on the table. And if that's a client who's walked in with the expectation that was $300 because they read an article, their reaction to that cost may be very different from somebody who has just spoken to a friend who said it's the best, 10 grand they ever spent. And what do we need to know about anchoring? And I want to ask this in a specific way, actually. Ultimately, in what you do, one of the outcomes is to achieve a certain result, right? And ideally, it's a better result than a certain benchmark. So you'll have people come to you and they'll go, I want you to get this result. But at the same time, you've got to be aware that you've got to do the right thing, not constantly try and meet certain expectations. How do you manage that desire to deliver against an expectation in order to get a client versus your knowledge in the back that maybe that expectation isn't realistic? You know what I'm asking?
Yeah, I mean, I think that we, in terms of the client's expectation of the outcome.
Yeah.
I mean, I think one thing we do on average compared to the industry at large is to be very balanced in the way we describe what we do.
Okay.
To try to make sure people understand the pros and the cons before getting involved in it. So one way to do that very easily is to talk about things that have gone wrong as much as you talk about things that have gone well.
Yeah.
And also to try to connect that point to the anchoring point for ourselves as well. If you're an investor, you're vulnerable to anchoring as well.
Yep.
And at the same time to talk about a stock that went poorly. I can take one called Rock Oil, which we owned for a very, very long period of time, and it delivered no positive outperformance over the full period that we owned it. Slightly, in fact, negative. So it was in the 40% or the 30%. It was another underperformance. And our job is to outperform, so that was a failure. However, having bought it at a high price, it fell a lot because of unforeseen things you couldn't have predicted. But the market marked it down far more than the fundamental shift would suggest. And so we bought more. And from those low, very, very low prices, those parcels that we bought earned returns of, say, 100%, some of them, really going forwards. So the overall return may have been zero or slightly negative, but the point is not what did I pay for it before, but what is it worth today? Forget those past decisions. I cannot alter those now, but would I be a buyer if I didn't own it today? So that's one thing on the investment side. And then, on the client side and the expectations of us to say if we can do this, which is a reasonable expectation, then we should be doing quite well for you. But bear in mind that that's an amalgam of outcomes in a diversified fund that includes the winners and the losers. And if we can push our ratio as high as possible, then we should do quite well for you over time. But patience is important. So it's to stress those things that are important to help us and our clients lean against these behavioral biases.
There's a piece underneath this which if you are working, I mean, ultimately this is the idea of the expertise, the guru, right, who just makes decisions. But I've often found that when you're talking, particularly an advisor, if you can be talking about the system, the way that you manage money, the philosophy behind it. In other words, this is a system which, if we follow it consistently, it's not going to win every time, but it's going to get a better result than if we don't go in with a game plan, we don't go in with a strategy, and we just play willy-nilly. Being able to talk about it in those terms, which you guys do, you talk about contrarian, that must really help in managing expectations because people start to focus on the methodology instead of just, I'm not getting the result, and it's kind of inbuilt.
Yeah. Yeah, I think so. I think one of the best things that I've read around, the best way to think about things and make decisions, which I highly recommend to anyone who's interested in, is a book by Annie Duke called Thinking in Bets. And Annie Duke was a professional gambler or like a professional poker player on the World Series and did extremely well. And what she kind of describes in her book is, that's the rational way to think about things. It is a bet because in life there is elements of skill, but there's also elements of luck. And all you can do is try and, assign some probabilities to what could happen if you have 2 or 3 divergent choices to make. But I think the interesting thing is that just because the outcome wasn't necessarily what you hoped for doesn't mean that it was the wrong decision in the first place too.
Yeah.
If you take an investing example, maybe there's a company that requires FDA approval, right, for their drug. And you think that if they don't get it, maybe the company is worth $100. If they don't get it, the price of the company will go to $0. If they do get approval, it'll go to $500, right?
Yep.
And you can buy that company for $100 now. And let's say you think that it's 50-50 chance. It's a rational decision to purchase that company if you have the capital. The expected value of the outcome is $250, and because the upside's so great versus the downside. But if you invest in that company and it goes to zero because they don't get the approval, you know, you can look at that. I mean, many people would look at that as them having made a mistake, when I don't think they have. And that's what Annie Duke talks a lot about in her book. You know, you can, in poker, you can make the right decision and still lose the hand. As long as you're playing lots and lots of hands over time, if you continue to make the right decisions, it'll put you in the best stead to achieve what you're looking for.
What's that? What people think success is like that, and what it's actually like? It's like, that's a really good thing to look at. And it's like the overall trend is like that, but it's not going to look like what, I mean, is sort of inbuilt. Let me ask, I actually want to ask one question. Guys, I'm going to open to questions because I know we're into the last 10 minutes. I can't believe how quickly time's gone. Guys, just in case, we run out of time, this is kind of, this is the top of the iceberg of a significant amount of IP and white papers you built around this. Is that correct?
Sure, yeah.
If people wanted to know more about this, if they wanted to know, understand more and more about how to use this to enhance their own decision making, the methodology behind what you do in investing, and equally importantly, how they might be able to push it to clients, how can they sort of reach out, get in contact with you? What would be the next step?
Well, I mean, by all means, they can contact us directly by email. We can maybe share them with you, Stu, so you can make those available to people if they wanted to get in touch.
Yep.
Or by phone, however, Chris and I. We certainly have a whole sort of library of information, papers, articles, presentations. I mean, I'm thinking some of our PD educational presentations have slides that are quite visual, easy to understand and useful with clients potentially. So we could put together a compilation of those sort of things.
Yep.
If that's of interest to people. But yeah, we're happy to be contacted.
So it's Julian, Morrison, that's 2 R's, 1 S.
Julian.Morrison at allangray.com.
Allan Gray. Beautiful. Okay. And yeah, I've seen some of your stuff and it's very visual, which I really like. There's a lot of visual sides to it. So if you're interested, shoot those guys through an email and, they'll get some packs to you. Okay. One of the questions that Elizabeth asked I really liked was around, decision blockers. What are common, when a client is sat in front of you and you can see that you can help them, or, there's something you want to do as a business owner, but you find yourself, not making the decision. What are some common reasons why people don't make decisions, and what are some ways of helping people to move forward?
Yeah. I think especially in finance, things are very long term. So, when we talk about, increasing our voluntary super contribution or something with someone in their 30s, the impact of that is such a long way out in the future that it can be hard to, that's a lot of these decision blockers come up because the thing is so far away in the future, and we're very bad at jumping 40 years into the future and thinking exactly how life will look like depending on if we choose this decision or that decision. That's a big decision blocker. The best thing to do is try and make it tangible for that person. I mean, you're probably going to need to probably ask them what they want their life to look like. And we're very visual. So they really need to think through, okay, what will happen in the future if I do this? What will happen if I don't do this?
Love that. Like, sit down. If we're having this conversation 20 years and you can see yourself in your perfect home and everything's gone well, what are you seeing? I think it's a really powerful. Are there any other common?
I'll just add to that. This is where, the so-called rubber hits the road into what we've been talking about. So to remember that people tend to overweight events massively that have strong emotional connection for them in their past. So past events that have been emotional for them will affect their decision making about going forward, particularly if there's change involved. So that's absolutely key. And I also think that it's again that sort of that comparison aspect. People are saying, how is this going to go? There's lots of noise surrounding people, so it might be what other people are doing. There's all this information. So, think about it this way. I boil it down to an investment comment, but think of this much more broadly, even eliminate investments. But from an investment perspective, I'm going, do I do this or do I do this? Or let's say there's 3 choices. Or am I going to make this one choice? Here's all this information. If you could, the ideal would be to get all the information that you think you need to make the decision, excluding what other people think, completely excluding sit in a room by yourself for a week or a day or whatever it would take and formulate your view logically why that would be. Give yourself the time. Then take that view with all your rationale and expose it to all the noise and go, how does this sit amongst all this noise? Does it make me feel like all of this stuff is nonsense? What's going on? And these people are herding and chasing each other? Or do I think that I'm wrong because of that? So I think independent thinking, allow yourself to be aware of what you're thinking and feeling, or your clients to be aware of what they're thinking and feeling and why, and try and detach from that, and be independent in their decision making.
Love it. Guys, I can't believe how quickly this has gone. You remember we were talking about how we're planning this, and I said, what's going to happen is this going to end up just racing through, and we'll talk about sort of a small fraction. Brad Scott, what about that's a good one. What about when clients' decisions are made determined by their partners or they change their thoughts? What's the question there?
The cop-out is to say to your partner, well, but you'll agree with me because you're smart and I'm right. But obviously that doesn't really help anybody.
In decision making, is there always a dominant partner in relationships, or is that not an area that...
I think the people on the line would know this as well or better than us.
That's true. Guys, I hope this has been useful. We actually had so much we could have chat. We could keep going at this for hours and hours, but I also know that you guys have got a massive body of content. So, like, if you're interested in some of the stuff we were talking about earlier about, working with clients to make sure they got the right information sources, there's a whole body of research. You dive deeper into the kind of the thinking systems. I think we just brushed the top of that. And I think the other area we didn't touch upon in any detail, we could keep going for hours. Might even do another session if you're up for it. Around biases, because I know a lot of you who are doing the ethics course right now, you're diving into, all these biases and things like cognitive dissonance. It's a huge tool in your arsenal to use when you want clients to make decisions that are in their best interest. But, guys, any final thoughts on this topic?
I just wanted to say also on Bradley's question there, I didn't want to be glib or anything, so maybe I can follow up on that, or me and Chris can follow up.
Which question was it?
On when clients' decisions are made determined by their partners and change their thoughts.
Did you want to answer it now?
I think it might sort of run into the end of the session, so we can sort of maybe give some thought to it and provide some feedback from a behavior.
No worries.
Chris, did you want to offer anything on that?
Yeah, I mean, I think it's kind of into two parts. Maybe a very quick thing would be, it is okay to change our thoughts. One of the biases that we have is, like confirmation bias. So we look for everything that supports the way that we already think. And we don't want to be inconsistent or seem to be inconsistent with our preferences. I'm not sure about what situation he would be referring to, and the advisors would be having a lot more of these conversations and probably innately know a lot more than me. But maybe it would just be to say that it is okay to reassess, especially when new information comes to light. So if one person has a certain view and other people contribute information, I think people shouldn't be too wedded to the original plan if things change.
I think always to revert back to the long-term objective and outcome that's shared. What is the longest-term common shared outcome that you can have, and then work backwards from there, and that can help resolve some of those decisions.
One of the things that, I may be reading between the lines on this, Brad, it might be wrong, but when you're engaging with a client and you've got a course of action, and then they go back and they speak to their partner or a friend and they go, you shouldn't do that, and suddenly they come back, I can't proceed. And I guess the obvious thing to say there is, firstly, if there's another decision maker at that close, then having them in the room is probably the most important bit. I generally won't do, that kind of conversation where a decision's got to be made if not all the people are there. But the other thing really to point out is, I think, going back to that thing on loss aversion and reward, ultimately we know that when you're making a decision, there's buyer acceptance, which is the reward, buyer reluctance, and buyer reluctance is always the stronger force. So if there are 1 or 3 or 5 things that are popping around in the background, this sounds great, but one of the things you've got to do in your discussions is draw that out and acknowledge it if it's true. And as to your point, you'll kind of say, yep, that's definitely a risk, and you're good. But have the opportunity to discuss it. And if one of the things is, there's a thought or a view that a partner's got when they're putting that forward, then you should draw that out and not just understand that part of it, but where it's coming from.
And I want to say, Stu, every decision has a pros and cons to it. So if the buyer reluctance is, here's the downside, then their course of action also has a downside. So highlight that and say, do you realize there's a downside to this, and that could be bigger than the downside you're talking about.
Yeah, sometimes you got to go, yeah, that's an absolutely viable concern. There was a risk, and you're absolutely right. But ultimately, yeah, it's something to be aware of, and you've got to make a decision as to whether you want to do X or Y, and know that that's it. Totally agree. Guys, thank you so much for your time. I reckon, by the way, guys, out there, if you're interested in, we could do this again, or alternatively, do reach out to the guys, because you do a lot of workshops on this. You've got all the material, but yeah, we could spend 3 or 4 hours on this, I believe. Guys, thank you so much. Any final thoughts?
All right. Thanks very much for having us, Stu.
Well, thanks so much, Stu. Thanks everyone for taking part as well. It's been great.
No worries. I'll speak to you all soon. Have a great weekend.
Cheers. You too.
Well, that's another episode of the Finnovator done and dusted. I hope you got a lot out of that. I hope you've taken maybe something that just piqued your interest and curiosity, or alternatively, maybe there's a conversation that you can have with clients around some of this. As always, stay tuned. We've got many more episodes of the Finnovator coming over the next 12 months. And if there's somebody you think would make a really good guest, or maybe you would like to be a guest on the podcast because you've just got a really interesting take on things. Maybe you're a subject matter expert with a story to tell, or you've had some success in your business and you'd like to dive into the story behind it, please drop me an email at help@ourdairy.com.au, and I would love to chat to you about your story. That's it from me. Have a great week.